Today, I want to talk to you about putting money into your 401k or your IRA and a strategy piece. So, the subtitle of today's episode could be why, if you have both a 401k and an IRA, why you always need to prioritize the 401k. But I want to tell you a little bit about some more nuanced strategy about your retirement plans, your tax advantaged retirement plans, and how to prioritize those. Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for self-employed people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're a creative or soul-centered entrepreneur or wellness practitioner who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your time and have a bigger impact with your work, you are in the right place. Hello, beautiful. I am so happy to be here with you today. I've decided to do a year-end series on bite-sized tax tips that you can take home. And every week from now until about the end of this year, I want to give you one tangible thing that you can do to save a bunch of money. All right. I don't know about you, but I am getting into practical mode. Like, let's just live life and make sure we can get the best out of it. So that's what I want for you right now. Last week, I kicked off this series with year-end tips to save you money on healthcare and including health savings accounts and flexible spending accounts. So if you didn't get a chance to listen to last week's episode, I highly recommend that one. Today, I want to talk to you about putting money into your 401k or your IRA and a strategy piece. So the subtitle of today's episode could be why, if you have both a 401k and an IRA, why you always need to prioritize the 401k. But I want to tell you a little bit about some more nuanced strategy about your retirement plans, your tax advantaged retirement plans, and how to prioritize those. All right. So with that said, let's just jump right in. Okay. The government offers these wonderful tax advantaged accounts that really, they exist as tax shelters to give you a bigger benefit, to give you a break on your taxes, to save you money. And the reason that these tax shelters exist is because it is in the US government's interest for taxpayers to save money for big ticket items, right? It is actually in the interest of the US to make sure that each of us has a secure and funded retirement. And so, because that is a hard thing to do, to save the kind of money it takes to be financially stable and secure after you no longer work, the government puts in place these tax shelters called retirement accounts, where you get a big tax benefit when you contribute to them and use them as a savings vehicle. Okay, so this is a really big deal. It's really awesome. I've done many episodes on IRAs and 401ks, et cetera. But today I want to really lock in on the difference between IRAs and 401k, 403bs. And I'll touch very briefly on SEP IRAs, which are a kind of an account that a self-employed person does have access to. And I want to talk to you about why, if you have a solo 401k, or if you work or your spouse works and you can access a 401k or 403b plan, why you need to make that, your funding of that plan a priority over funding your IRA, right? The IRA should be funded last after you make sure you max out your 401k, 403b. Okay, so let me get into the sort of background you need to understand this priority. So a 401k or a 403b is basically just a type of retirement account. Generally, it's a workplace-based retirement account. It is administered in general through an employer, okay? So usually if you are covered by a 401k or 403b. It's a really generous plan. There may be employer matching, which you should definitely always take advantage of if that exists, and most plans do have it. But these are generally a workplace plan, but what I want you to understand, and the 401k is generally offered by a for-profit business. A 403b is effectively the same thing as a 401k. It's just offered through a nonprofit. So for example, I used to teach painting at Boston University, and I was covered by a retirement plan there, and it was a 403b because Boston University, like most universities, is a nonprofit institution. Okay, so I'm going to just say 401k for the record here, but just know that 403bs basically have effectively the same rules as 401k. So if you have a 403b and not a 401k, this really does apply to you as well. So 401ks and 403bs, they're awesome. They're generous. The contribution limit for the calendar year 2024 is $23,000. And if you have a traditional plan, you get that benefit up front, meaning if you put any dollar you put into your 401k is a dollar you are not taxed on for this year. In other words, you can get the tax savings on up to $23,000 of income. So if I made $100,000 of income for the year and I put in the maximum to a 401k, then my taxable income would not be $100,000. It would get reduced by $23,000. In other words, let me do that math in my head. I would be taxed on $77,000 of income, not $100,000. That would lower my taxes substantially. All right. I might be saving, I'm just roughing it here, but maybe $4,000 to $5,000 in income tax. So that is a big boost when you do that. And part of the reason that that exists is we want you to have that boost. We know that saving for retirement is difficult. And so this savings vehicle is literally given to you on purpose to make it easier to save. So in contrast to a 401k, an IRA is an individual retirement arrangement. That's what IRA stands for. And the individual part means essentially it is per person. So each spouse has their own limit, right? And it also means that it happens outside of a workplace. So you can set up your IRA whether or not you are covered by a retirement plan at work. And you can set it up if you don't have any retirement plan at work, right? So the IRA is a great option if you are not covered by a workplace plan. And I do think that at a minimum, everyone should do their best to max out their IRA every year. Now, the IRA limit is $7,000 per year, or there's a catch-up contribution of $1,000 if you're over age 50. And that $7,000 is the 2024 limit. Okay. Now, IRAs can either be traditional style, where you get a reduction off of your taxable income for every dollar you put in the year you put it in. That's traditional style. Or there's a Roth style, which is where you get the tax benefit on the way out. In other words, you don't get a reduction in your taxable income this year for the amount you contribute, but when you take the money out, it is tax-free. So that's a big deal. So IRAs are awesome. 401ks are awesome, but there's some differences between them, and I want you to understand. One, a 401k also can be set up by someone who works for herself. So I'm a good example of this. I have set myself up with a solo 401k. So the government is not allowed to say this type of employer can set up a 401k, but solo employers cannot. In fact, you have the right as a person who works for herself to set up a 401k plan even though you just have one person working for you, yourself, right? So it is okay. A solo 401k is a good option, although I will tell you that it tends to be something that requires a little more administration than an IRA. And so because of that, there may be a little bit of fees that you pay to have, to maintain the plan. You have some like technical requirements from the IRS. So it tends to be a business that has sort of been operating for a little while, is making a little more money, that is able to set up a 401k. But if that's you, a solo 401k is a great option. Okay, so as I talk about 401ks, this is not only something that applies to people who work at a big company. You absolutely can have a 401k as a self-employed person. And I am a good example of that. I have one. So, a big and important difference between 401ks and IRAs, however, is the deadline. Okay. There is a reason that you should always prioritize a 401k first before you max out your IRA. And the reason is this: the deadline to put your full contribution into your 401k is the calendar year. December 31st is your last day. Now, some plans actually allow you to put in a lump sum contribution at the end. The IRS will allow that, but not every plan will allow you to do a lump sum contribution. So that's just a little detail that if you kind of forgot to set up your 401k contributions through your payroll, it's not too late to make sure something goes in. You can put a chunk at year end if your plan allows it. So a little task for you, if that might be you, is you want to reach out to your HR person right now or whoever administers the plan, and you want to ask if that is a possibility. Okay. It may or may not be according to your plan. So with that said, in general, how the 401k works is it is generally set up at a company that has payroll. So you set the 401k plan contribution up to be taking money out of each paycheck, which is lovely because you don't feel it as much. And you put in the same amount with every paycheck. You generally are setting this up as a percentage of your pay. Okay, so the calculation can require a little bit of math, but it's not that bad. So it can be hard to sort of make a big change to your 401k contributions, especially late in the year, unless you have a plan that allows for a lump sum contribution. So that's just a thing to be aware of. The other thing that you really, really have to be mindful of is that your deadline to put the maximum in for the year is the calendar year itself on a 401k plan. So you can't wait until April 15th and put any money in retroactively. Now, I want to contrast that with an IRA. An IRA, an individual retirement arrangement, the deadline for an IRA is different. It's tax day. It's April 15th, meaning you can put money into an IRA up until April 15th and retroactively count it towards the limit of the year before. So this is a really cool feature of IRAs. It's really great. And it's something that you can do after you've already maxed out your 401k, right? But here's the thing. An IRA is something you can only contribute to if your income is below certain thresholds. And those thresholds get even lower if you are covered by a 401k. Okay. So if you are covered by a 401k and you don't contribute to it, the IRA doesn't care. The IRA still says you can't put money in here because your income was too high and because you had access to this plan, even though you didn't use it. So it is really, really important to use your 401k if you have one. Okay. Don't assume you can put money into an IRA if you have a workplace plan that you're ignoring. Okay. If you have a 401k, you want to use it. That is the top priority. It's got a much higher contribution limit, $23,000 versus $7,000. Plus, it has an earlier deadline. So, of course, you want to do that first. Plus, the fact of having one at all can lock you out of using an IRA. Okay. So, I hope that illustrates to you the deep importance of funding your 401k first. And if you still have money you're able to contribute after that, then you want to go ahead and maximize your IRA. Okay, that is my takeaway for you today. I am going to link you to a chart. It makes for very boring podcast listening for me to kind of tell you what these income thresholds are when you're covered or not covered by a 401k plan. But I will put a link in today's show notes to a chart like that so you can take a look at what those contribution phase out limits are for contributing to an IRA when you are covered by a 401k or a 403b at your workplace. Okay, so if you have only an IRA and you don't have a 401k, it's also good to know that you can put the money in now. You don't have to wait until you do your taxes, okay? Your limit is $7,000 for the year if you're under 50. It's $8,000 if you're over 50. And you can put the money in now You just have a deadline of April 15th. There's no rule that says you can't be early. And, with investing, you generally want to have your money in as long as you can. So it's good to go ahead and take advantage of it. All right. So I hope that was really helpful for you. I want you to be factoring into your budget and just in your psychology an idea of putting away money for yourself for the future and taking advantage of these tax advantaged accounts that really, really help you maximize your savings because they reduce your taxes when you use them. Okay. So you're still putting money towards something great, but you're getting an additional tax benefit when you do it. All right. Oh, I forgot to mention that the SEP IRA is one more type of plan that is really common and wonderful for self-employed people. It stands for Simplified Employee Pension, which is a confusing title, but just know that the SEP is a great option for somebody who works for herself. And contribution limit for the SEP IRA is a little different from 401ks and IRAs. The SEP IRA, your contribution limit is 20% of your Schedule C profit. So the important thing to know for contributing to a SEP IRA is that one, you can't know your exact dollar contribution limit until you do your taxes. So the SEP IRA is the only one of the retirement plans that you can contribute to even when you have a tax extension. So even if you have an extension and you file in October, you can make your contribution up to October. There's no other plan that gives you that long. But the reason is you have to know the number on your Schedule C to be able to determine that contribution limit amount. So it's important to, at this time of year, do some bookkeeping and get a general sense of how much income you have for the year, how much profit you have for the year, and where you won't be able to get down to the exact, credits and every little detail of the exact dollar amount of taxable profit you have, because some things will shift a little bit on your tax return. You can get a rough sense of what 20% of your profit is right up front. And you can go right ahead and contribute that money to your SEP IRA. You can go ahead and invest it. Just be aware that if you over contribute, you will have until the tax deadline to remove that over contribution amount. You will have to take out any excess you put in, or else you'll owe penalties. Okay. So that's what you need to know about the SEP IRA too. That's another great option. And its deadline is a little different even from the other two. All right, I hope that was really helpful for you. I also want to let you know that this week on Thursday at noon Eastern time, I'm offering a free class. So speaking of saving money at year end, I'm offering a free class called Make Taxes Easier and Stash an Extra $130K in Your Savings. I'm going to be teaching you the 4 mistakes that every creative person makes on their taxes and why they cost you so much money and stress. And I'm also going to be showing you my 4-step framework to make your taxes easier and less stressful and save more money. I will actually be going through some of the math of using an IRA so you can really see the numbers of how much more money you get when you save for yourself through an IRA. So I hope that's really awesome. You can register for that free class at go.sunlighttax.com/free. That's go.sunlighttax.com/free. I will see you in class on Thursday and enjoy. See you next week. Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.